What's an ETF stock? An ETF, or exchange-traded funds, is a marketable security that tracks an index, a commodity, bonds or a basket of assets like an index fund. Exchange-traded funds are traded on exchanges much like stocks. An ETF may hold various investments like stocks, commodities, or bonds, and trade close to its net asset value over the course of the day. What are the benefits of ETFs? 1. Low costs. One of the biggest advantages of ETFs is that they have very low fees and expenses. For example, the S&P 500, SPY, has an expense ratio of just 0.09%, while the average mutual fund has an expense ratio of 1.19%. This difference may not seem like much, but it can have a big impact on your returns over time. 2. Diversification. Another benefit of exchange-traded funds is that they offer built-in diversification. For example, the S&P 500, SPY, tracks the 500 largest companies in the U.S. stock market. This means that you are automatically diversified across hundreds of different companies and sectors. 3. Tax efficiency. ETFs are also more tax efficient than mutual funds. This is because ETFs trade on exchanges and are not subject to capital gains taxes every time they are bought or sold. Mutual funds, on the other hand, are subject to capital gains taxes when they sell securities for a profit. 4. Flexibility. ETFs also offer investors more flexibility than mutual funds. For example, you can buy or sell index ETFs at any time during the day on an exchange. Mutual funds can only be bought or sold after the market closes. 5. Liquidity. ETFs are also more liquid than mutual funds. This means that you can get in and out of an ETF position much easier and with less impact to the price of the security. 6. ETFs pay dividends. What are the risks of ETFs? 1. Market risk. Like all investments, exchange-traded funds are subject to market risk. This means that the prices of ETFs can go up or down based on economic and market conditions. 2. Tracking error risk. Another risk associated with ETFs is tracking error risk. This is the risk that an ETF will not accurately track the index or benchmark it is trying to replicate. Tracking error can be caused by a number of factors, including fees, expenses, and the way the ETF is structured. 3. Volatility risk. ETFs are also subject to market volatility risk. This is the risk that the prices of ETFs will fluctuate up and down in value. Volatility can be caused by a number of factors, including economic and market conditions. Common types of ETFs. 1. Equity ETFs. Equity ETFs track stocks or indexes of stocks. These ETFs can be used to gain exposure to a particular market, sector, or region. 2. Bond ETFs. Bond ETFs track corporate bonds or indexes of bonds. These ETFs can be used to gain exposure to a particular bond market or type of bond. 3. Commodity ETFs. Commodity ETFs track commodities or indexes of commodities. These ETFs can be used to gain exposure to a particular commodity market. 4. Currency ETFs. Currency ETFs track currencies or indexes of currencies. These ETFs can be used to gain exposure to a particular currency market. How to invest in ETFs. 1. Decide what you want to invest in before you start investing in exchange-traded funds. There are ETFs that track virtually every asset class and market imaginable. 2. Research the ETF. Once you have decided what you want to invest in, you need to research the ETF. You can find information on ETFs on a variety of websites, including the website of the ETF provider. 3. Open an account with a broker. In order to buy and sell ETFs, there are a number of online brokers that offer commission-free trading for ETFs. 4. Place your order once you have opened an account. Investment strategies. 1. Buy and hold. One popular investing strategy is to buy and hold exchange-traded funds for the long term. This investment strategy involves buying ETFs and holding them for years or even decades. 2. Dollar cost averaging. Another popular investing strategy is dollar cost averaging. This involves investing a fixed amount of money into an ETF on a regular basis, such as monthly or quarterly. 3. Active trading. Some investors also engage in active trading, which involves buying and selling ETFs frequently in an attempt to profit from short-term price movements. Active trading can be risky. ETF examples. Some of the most popular ETFs include 1. SPDR S&P 500, 2. iShares Core S&P 500, 3. Vanguard S&P 500, 4. iShares Russell 1000, 5. SPDR Dow Jones Industrial Average, and others. Conclusion. Exchange-traded funds are a type of investment that offer many benefits, such as low costs, tax efficiency, and flexibility. If you are considering investing in ETFs, it is important to understand how they work and the risks involved. Thanks for watching. Please like and subscribe for more related videos on investing.